following is an update and technical analysis on the U.S. equity markets, the S&P 500 Futures, U.S. Tech 100 Futures, and additionally as well as the U.S. 2000 Russell Futures, based upon the daily interval. Well, we had some big headlines rock the equity markets today, in the Federal Reserve deciding to keep interest rates at their current levels, which was in line with expectations in the market. And in a more hawkish move, the Fed removed the anticipated 50 basis points of rate cuts from its future projections in the dot plot, which indicates a more aggressive stance towards tightening monetary policy. Whereas the Fed revised its economic outlook by raising growth expectations, lowering unemployment expectations, and increasing its inflation outlook. Where I am in the tune, where I firmly believe that the fate of both the stock and housing markets heavily relies on the pivot stories, AI bubble stories, and a return to the zero interest rate policy in what some call the ZIRP program. And it's essential to note that in 2024, many debts are set to reset, including a significant portion of outstanding U.S. Treasuries, which will require high yields to attract investors. If you're leveraged or on margin and or overvalued stocks, hoping for a return to zero interest rates, I would firmly be cautious. Where the U.S. 10-year Treasury has just put in a daily solid candle close above resistance, highly correlated with the mortgage markets, where I believe are poised to reach 8% pretty soon here, where many company stocks have been propped up by buyback programs, I believe will crumble when earnings suffer and new corporate bonds must be issued at significantly higher yields. Whereas we have where I've continued to pound the drum, shorting Alf Beauty, honing in on TJ Maxx, the resumption of student loan payments will exert a significant drag on the economy. Where I was reading an article that the ban now on Airbnbs and short-term rentals in cities will further depress the housing market as more supply enters the market, a move aimed at reducing housing costs, but at the expense of investors who purchased properties in 2021 and 2022. But the reality, the test will come when the consequences of rising interest rates hit DC, revealing the true extent of its resolve. The Federal Reserve's power is limited when confronted with an executive branch that appears to be undermining the nation's fiscal stability. And here we are deep diving into the U.S. 500 futures based upon the daily interval, and we have a breakdown sell signal based upon this primary reactionary uptrend line off the 2023 March Silicon Valley crash lows, where the regionals were getting absolutely destroyed and bludgeoned. We had multiple backtest retests, nice key reactionary lows right across that board. And here we are. We need a backtesting really to the button amongst the 44, 45.70 price resistance, and was rejected impulsively on a solid daily candle close sell signal below this primary reactionary minor uptrend line, correlated with additionally the 618 fibs retracement and now the 100 daily moving average. So we are on a dual line of support, whereas we could have a dead cat bounce and or snapback, big counter trend rally right into the primary reactionary uptrend line, which would add to an existing short trade position, if not an objective re-entry, recycle, hard short trade setup to move to the downside, whereas you have a confirmed bearish crossover in the moving average convergence, the oscillator potentially already gunning down below its zero line. And again, it's already been a big move to the downside, if and when, where the risk reward ratio lies heavily to the downside for additional targets to be met and hit, which would be down to the 43.63 price support for 1.3% crash, down to 50% fibs retracement for a 2% crash. Additionally, the 382 fibs retracement, 42.64 for a 3.5% crash, and then ultimately down to the 236 fibs retracement correlated with the 41.88 price support for a 5.2% crash, and then back down to the primary reactionary downtrend line for a 5.6% crash, in which will be the ultimate moment, multi-year moment of all key inflection points, which is based upon the primary reactionary uptrend line off the November reactionary lows of 2022, since Powell had started the additionally the rate hike. And it will be strongly correlated with the 236 fibs retracement, and that will be the line in the sand, in my opinion, and a breakdown sell signal, which I would call the recession primary uptrend line, if and when we go on to retest that key pivotal transition point. Taking you to the U.S. Tech 100 Futures, based upon the daily interval, same picture here. We had a beautiful breakdown and perfect, really, to the button on a complete backtest right amongst this primary reactionary uptrend line and the entire trade. Watch out for a big breakdown sell signal right across this key major price support level. That was good for a 2.2% crash at the downside, testing the 14,974.60 price support, pretty major price support level here, with additional reactionary highs and reactionary lows really across the board. Call it an entire multi-month price support, whereas long traders and or bull traders need to successfully defend this price support level as of now. Again, where we get that, where we additionally would have the backtest scenario where we have a nice steep counter trend rally and or punchback rally, which would be all the way right back up to the trend line, measuring it for all the way back to the 786 fibs retracement for 1.8% gains in a move to the upside, which again would add an objective short trade entry, if not an add-on to your existing position for a great risk-reward ratio move to the downside. And then additionally, you have this primary reactionary downtrend line resistance, just a ton of resistance up above here. And this is major price resistance up above, which could correlate with the 786 fibs retracement if and when we go on to retest that level. Correlated now with that primary uptrend line is the 50-day moving average and the 786 fibs retracement, called a triple transitioning line of resistance, which would provide the most valuable short trade setup to the downside. Whereas we even have a potential peak and or snapback counter trend rally breakout above that, that would give you, again, the most ultimate value there off that price support resistance level if and when we go on to retest that level to keep this near-term downtrend intact. Make no mistake about it, here on the much larger picture on the daily interval, we are in a near-term downtrend with a bearish crossover in the moving average convergence starting to test the zero line threshold as of now, and additionally with the zero line oscillator, a price percent oscillator, testing its zero line threshold as of now. And I believe we snap this level. If we take out the 14,974 price resistance, you're going to put an Excel damage below these technical momentum indicators, only increasing the odds for a much larger drop, especially when you have these negative and or divergent high bearish divergences that had just continued to construct and establish amongst all three technical momentum indicators going back since June, where I first started recording these videos based upon the equity markets, and it has been an onslaught since, where we began shorting right upon some of the key inflection points where we had a rally that just looked like it would never stop, and the waning energy within the technical momentum indicators told the entire story. Taking you to the US 2000 Russell Futures based upon the daily interval, and we have an additional breakdown sell signal based upon the 1819 price support. I had added this primary benefit of a doubt, primary additional reactionary uptrend line, multiple reactionary lows, reactionary highs really across the board to help validate that key segment. And here we are on a perfect backtest retest based upon the breakdown backtest scenario. And thus far, that entire trade so far has been good for a 2.1% crash to the downside. Now officially taking out the neckline that I continue to stress and hype up based upon the 1819 price support. We had a minimal reaction there where we ended up having a backtest reactionary low, ended up slamming and having an outright snapback counter trend rally right into the bottom of that primary reactionary low price resistance, and was rejected impulsively right off that key inflection point. Make no mistake about it, 1819 price support now has become resistance, and that is a major price support level with multiple, call it a multi-year price resistance of reactionary highs and reactionary lows really across the entire sphere here. And that is going to be just a monumental key inflection point if and when short sellers, bull traders, long traders are unable to successfully withdraw and have a whipsaw-like reaction, bear trap recovery amongst the 1819 price support, only increasing the odds for a much larger drop on a double-digit crash to the downside, confirming the head and shoulder classic looking top that I have been hyping and harping about for months on end. Whereas you have the zero line threshold already broken down below and backtesting off the moving average convergence in a beautiful gaping crossover, bearish crossover sell signal, only increasing the probabilities of a recharging effect on a bigger breakdown sell signal move to the downside, whereas damage has completely been inflicted upon these technical momentum indicators. Whereas only time will tell if we get that backtest scenario, an additional backtest scenario, or a recovery of the 236 fibs retracement, or we just start taking off, bond yield starts to soar, and we'll see an outright panic selling, forced liquidation, margin calls, stops to go off, and an all-out bloodbath on Wall Street.